Hi guys, today we're going to be discussing a fundamental indicator in this video which has historically been a pretty good indicator, I would say, to signal a start of a bull run. I've briefly done a video on this topic quite recently on the US market, though only because I was fascinated by it. I wanted to learn more and sprinkle the facts, as you know. And once I've done that, hopefully you might feel a little bit more comfortable being in the market for the medium to long term. So what exactly is this fundamental indicator and why is it so important? Well, it's actually called CAPE, the CAPE ratio, and it was invented by John Campbell and a Nobel Laureate named Robert Schiller, and it currently indicates a bullish outlook for stocks. What does that mean? Hold on, you might be thinking, and it is hard to reconcile this with all that's happening in the real world. I mean, we have a depressing economy with lockdowns, businesses closing left, right and centre. To be honest, I don't even know where we are anymore, with some shops open and others aren't open. Some days you can meet people, other days you can't, and blah de blah de blah, right? I'm so thirsty today, I don't know why. And anyway, but despite everything that has been happening in the real world, we have to be a little bit surprised with how decent holistic returns of the equity market this year have been. The stock market has pretty much rebounded to all-time highs. Many, and myself included, retail investors who have just attached themselves to the beat of the market by buying blended or index funds would have outperformed institutional type of investing. Naturally, with all this hype then, it does make someone like myself included think whether there is a little bit of a bubble going on. In this kind of situation, we have to remind ourselves that firstly, markets don't reflect the true economic condition, but the forecast, it's the future outlooks. And secondly, markets recover pretty quickly after an initial shock even. And if you don't believe me, go check out some of our favorite YouTubers like Andre Gic at the time of the pandemic, where we had immense shocks. He had some excellent videos around rebounds. Also, we have to say, speculation sells, guys. Booms, busts, bubbles, and also recessions make great titles and thumbnails. We all know that. However, looking at fundamentals and the fundamentals that drive the market, there are several indicators that a bull run is on the card. Firstly, let's talk cash, right? With all the uncertainty, investors are still holding on to record amounts of cash. I mean, where else would you even put it? With interest rates being as low as they are and real rates being negative for even us consumers, it's what we call financial repression, and many economists predict it could take as much as a decade to move away from this kind of condition. And that's great for holders of debt like governments, who can reduce debt burdens and limit tax hikes. And the vaccine is here, and there are great headlines around the world with vaccine programs now underway. A monetary policy which accommodates the world's economies for a bounce back situation and minimizing lag of growth. We recently talked about the changes in politics in the US, and guys, I'll put a link in my description below with a little more detail if you want. But what about those people out there that are panicked about these bubbles? Forget those that are panicked, full stop, and include those that are concerned and nervous about the outlook. All of these point to high valuations, of course, and the initial rational answer to this is that different sectors have performed differently through the pandemic, and we call it the K-shaped recovery, where certain sectors that were hit the hardest, entertainment, travel and leisure for example, were falling, and those where demand has not been affected or even spiked because of lockdown has increased. For example, the fact these are Facebook, Apple, Netflix, Google's of them all. So with all of that being accounted for, the CAPE ratio suggests that now is a good time to buy stocks, guys. And what is the CAPE ratio? The CAPE, CAPE ratio, stands for cyclically adjusted price earnings ratio, and it was developed by economists John Campbell and Robert Schiller and presented in 1988, a time when I probably couldn't even walk. Schiller went on to develop the work on CAPE a lot further and won the Nobel Prize in economics in 2013 for his work on asset pricing, and also went on to write various books and articles on this exact topic. So in short, he knows his thing, and we should pay attention to his research on this. Actually, he basically found out that returns on stocks was correlated to inflation expectations. Real returns on stocks versus bonds and long-term interest rates. Now, cheap money and certainty that it will be cheap in the future means companies will go ahead, invest, and consumers are okay to make purchases with rates low, holding cash rather than putting expecting it to work feels naive. That's basic knowledge, right? So cue the CAPE and super me. So the CAPE is a long-term measure and a long-term indicator for the stock market itself, which is fine. And we should be long-term investments. Look at that long-term horizon when it comes to the stock market. Actually though, it is useless for measuring short-term performance and returns. And so it would be pretty risky to do that. If you don't have the stomach for being in the market for a long period of time, then it probably isn't the right form of investing for you. And I'm just saying, but you know, you're down to your own decisions. So let's get on to the juicy bits. What does the ratio actually tell us? Well, in March 2020, the CAPE bottomed at 23. And to give some perspective, the CAPE is to gauge how expensive the market actually is. And in the last 20 years, the CAPE has averaged 25.6. And as of December 2020, it sits at 32. And this was around the same level during January 2018, before the dot-com crash, and in the 1920s, before the Great Depression. Does that give you goosebumps yet? With the current ratio being over 30, investors are pretty much puzzled with the conclusions appearing in the financial news, and also from Schiller himself, that the consideration is that equities are attractive. And why is that? Well, in very simple terms, it's because interest rates are so low that it goes Christopher Nolan in Tenet. Guys, have you even seen that movie? It is a mind bender. Just go watch it if you haven't already. And it points to 2021 as a very interesting year for equity investors, and it concludes a bullish outlook for 2021. Who was that just slamming the door nicely? I do cover the Tenet effect and the Roaring Twenties Gatsby style in a couple of videos, which are linked right here, so go ahead and click on. I'll